Good evening, ladies and gentlemen. Myself, Daniel, representing PMS Bazaar. I welcome you all for this insightful session, which is very relevant to current market scenario. Future is not equal to past. On behalf of the participants, I welcome Mr. Anand Shah from ICICI Prudential AMC. Before I hand over to Anand Shah, let me give a quick introduction. Mr. Anand is a head PMS and AF investments at ICICI Prudential Asset Management Company. He has more than 2 decades of rich fund management experience in the asset management industry, most recently as CEO of NJ Asset Management. Prior to this stint, he was Deputy CEO and Head Investments at PNB Paribas Asset Management India Private Limited, responsible for investments and overseeing both onshore and offshore mandate and sales. Anand has previously won many laurels and prestigious award for his fund management. He was the recipient of the CIO of the Year Award 2014 and 15 from Asia Asset Management, and he has also won multiple other fund level awards for his investment performance. So without further delay, I am handing this session to Mr. Anand. Anand, over to you, Anand.
Thank you, Daniel, and good evening. Thank you for this opportunity to PMS Bazaar, and thank you one and all who has joined this webinar for sparing your time. What I'll do, and the whole idea is in next 30 to 40 minutes, let me give you a little bit of, and it's a short time, I have to explain a lot, but in next 30 to 40 minutes, let me share with you what I think of, equity markets, what I think of economy in the short to medium term, and what are the opportunities. So then we will leave enough time so that we can do some Q&A also in that situation. So yeah, so the whole idea of this presentation would be to eventually share with you the concepts which we use on a daily basis to build a portfolio which is fairly resilient. So at the end of the day, we need to have portfolio of stocks which can survive the difficult times and thrive in the good times. I think that's very important. And in that sense, the whole idea is to build a resilient portfolio. Let me quickly take you through some of the aspects. Before we move, forward, I think for many equity investors, there's always a problem of, आज market ऊपर जाएगा या नीचे जाएगा, whether the market is going up or going down. And that always keeps you away from equity markets. A very rightly said by one of my ex-colleagues that investing in equity might be risky, but not investing in equity is riskier. And I'm telling you why. Because over a long periods of time, inflation eats into your purchasing power. आपका जो पैसा होता है, that keeps on devaluing as inflation keeps on taking the price of the product that you are going to buy with that money keeps on rising, and that's why that same 100 rupee can purchase a lot less. And to that extent, the money meant, आज से 10 साल 15 साल बाद 20 साल बाद जो savings हम आज करेंगे, I think that money needs to be invested in equity from that perspective. Everybody, we all know gravitational force. We all think that anything that goes up will come down. But if you see, as far as the equity markets is concerned, generally the market tends to, go down to eventually go up. And there's a reason to believe why that happens. For the simple reason that in equity market, the big part of the market movement is delivered from the EPS growth rate. And what you see when the market is going up or market is going down is more of volatility. It is more of a P multiple of the market going up and down. And to that extent, in the long run, market with all the corrections that you have seen in 2008, you have seen in 2000, more recently in 13, 14, 15, or more recently in 2020, the market tends to go up eventually eventually it tends to go up uh, uh, because the EPS, the delta EPS is very important. The EPS of the market, which eventually goes up. So just let me again share my screen so that. So if you see this chart, which nicely shows that with all the volatility, the market eventually has a way up, which is important. As I was sharing with you that it is a delta EPS which eventually drives the market. This delta PE multiple, which tends to distort, which it tends to reduce the overall experience of the investor. But I think in the long run, it is a delta EPS which drives the market. Further, when we did a 15-year study and when we saw the various aspects of the market, watched what delivers the returns for the investors, it is the delta EPS which is a big driver. The other big driver of the market has been return on equity. So I'll come to this a little later. When we saw in the previous slide, the delta P multiple, it is driven by ROE. So I think when I will show you the specifics of my portfolio, you'll realize, and this is what I'm going to use, that at the end of the day, for a lot of wealth creation that is going to happen over a long period of time, there are two things that matter, the EPS and ROE. So that, with that starting point, which I wanted to share with you, if you see this slide also, it keeps on showing all the brown line are actually the times when the market has reached 52-week high. And these are the brown lines which keeps on coming back again and again in the marketplace. So this is the brown lines which tends to be the every time the market is at 52-week. And this is what I want to tell, that every second year, third year, fourth year, market will keep on hitting the trade. Having said that, very important is to have times. Every time we believe कि market हमने खरीदा, when we bought it, the market should start going up from that day. That doesn't happen. Invariably, every time you buy the market, there's a less than 50% chance or a 50% chance that the market will go up. And there's also a 50% chance that the market will go down. This slide particularly tells you that in a quarter, there is a equal amount of chance that you will make money or lose money. But as you increase the time horizon, if you go towards 1 year, your chance improves. You go towards 3 years, your chance further improves. You go towards 5 years and 10 years, your chance substantially improves to make money more than the FD 6% return that we're talking about. So that brings to the end of little bit of a introduction I wanted to give you on equity market. Very, very important that you come with a long-term horizon, because that is what is a test. The market being what it is volatile. If you don't come with a long-term horizon, you'll not benefit fully from the equity market. Whereas in the short-term market will always be 50% chance. Where do we stand today? Today is that point of time when things are very difficult. We all were coming out of COVID and we were celebrating that the economy will pick up, but we are also aware that as everybody starts spending, the inflation were to go up. What this Russia-Ukraine crisis does, it actually aggravates that problem. If you see, they have a little bit of control on the fertilizer, so they also big suppliers of phosphorus and nitrogen in the NPK. They are also big supplier of select produce like wheat and sunflower oil and others. They have a lot of coal, coking coal, and oil and gas. They're a big supplier of energy to Europe, and in a smaller extent, but they're also a big supplier of metals. So what this crisis does is it limits the supply of many of these stuff from Russia and Ukraine put together for a short period of time, maybe for 6 months, for 1 year. But that means that inflation problem, which we're expecting to be benign high inflation, is now actually significantly high. The response, obviously, if you see, is central banks of all the governments will have to raise the interest rate to curb the demand. So I think the bottom line here is that we should be prepared. We should be prepared to have a lower growth. That is very important. This growth which you are seeing here has to be significantly lower than what we were expecting post-COVID. So that's one part which eventually bring down. So bottom line is that in the short term, we are looking at lower growth rate, and to that extent, especially stocks which have significant growth priced in are the ones which are at more risk than the stocks which are not expecting too much growth from them. That brings me to the second part, which is, future. This is the main part. We are very, very excited to share with you some insights on the markets that we find very interesting, and that also tells me that market is going to be significantly different from what it had been in the past. If you see this chart here, was the period from 2015, even before, prior to that, when we had short-term challenges in the market, but overall the macro was not bad. But if you see here, we had significant, I would say, challenges in terms of earnings growth rate. Be it large cap, be it mid cap, small cap actually had a significant lower earnings, had a negative earnings growth rate over period. Mein. You go further, which is particularly from January 31, जहाँ से COVID का impact शुरू हुआ. We had a significant lockdown in March. Obviously, we had some recovery, but फिर March 21 में वापस second wave impacted the markets, and more recently, Russia-Ukraine has been impacting the markets. But the surprising thing, or the good part, is that the earnings growth rate has really picked up. When I divide this earnings growth rate into two parts, and this is what we've been doing, the B2C companies which were selling to the household, were actually doing very well even in those times. It was the companies which were manufacturing, which were competing with China in some way, and which were supplying goods to these B2C companies. They didn't have pricing power. क्योंकि anything you to produce in this country, safety pin ले लो, या आप क्रेन बना रहे हो, या आप बॉयलर टर्बाइन बना रहे हो, आप टायर्स बना रहे हो, टाइल्स बना रहे हो, लाइट्स बना रहे हो, फर्नीचर बना रहे हो, anything that you are manufacturing, China used to dump it cheaper than what your cost of manufacturing was, which also meant that there were almost 10 to 15 years when the manufacturing declined in this country. A lot of manufacturers closed their shop, went to China, buy stuff, and sell in here. So everybody became a trader or a B2C company, and less manufacturing we saw. I think the good news here is that after a lot of effort made by the state governments and the central government, but also the environment that exists in the world, where the world wants an alternative to China, the world wants an alternative to Russia and Ukraine. I think the manufacturers is what is driving the real profit growth rate as we see in last 2 years. So surprisingly high earnings growth rate we are seeing, because B2C companies are still doing well, though they are doing far inferior growth rate than what they were doing in the past. The expectations were much higher, but surprisingly the manufacturing and mining companies which are doing far better. And that also reflects how the manufacturing and mining companies were underperforming in last decade have started outperforming the so-called quality, high PE B2C companies here. So that's I think somewhere I wanted to emphasize here. Okay, there has been a significant underinvestment in mining and manufacturing. यहाँ तक कि हमने forget investing in manufacturing, हमने काफी manufacturing we had to close down also because they were not making money. That reflected in NPAs also. हमारा banking में there was significant NPAs also in 2015, 16, 17, 18, 19 because the manufacturing didn't make enough money. I think that is what is changing, and that is what when we are saying future is not equal to past. One, the earnings growth rate, if you see earnings PAT to GDP for corporate India was also falling from 7-8% down to 1.5%. That has also improved as the earnings growth rate is picking up and becoming faster than the GDP growth rate. But also within that earnings growth rate, manufacturing mining companies is what we are more. I think overall, when I'm looking at the market, a lot of good has happened in this country over the last 5 years. And a lot of external factors, जैसे कि China letting go of a certain low-end manufacturing, or what's happening where the world is looking for alternative to China. Our own economy is coming out of shocks that we had in the form of demon, GST, NBFC crisis, Yes Bank crisis, slowdown in the economy, and then the and then the COVID and others. वहां से, anyways, the economy is looking up. Government has significantly invested in infrastructure that will also help. But otherwise, also various reforms we have done will improve the profitability. And that is why this is a very important slide. हमने पीछे भी बताया था कि the change in the market is a function of delta in EPS and delta in PE multiple. So if you see, पिछले 13 months from 1st April 2021 to 30th April 2022, while the market has moved up by only 15%, if you see, the market has become cheaper. 1st April 2021 में 33.6 was the trailing PE multiple for the market. It was very expensive. But because from COVID lockdowns, the market was recovering, the earnings growth rate was very strong at 76%. So even then, when the PE multiple has dropped from 33 to 22, your market has actually gone up and delivered 15% positive returns. Obviously, within this, manufacturing, mining has done much better. So I will show you that when we will cover a little bit of our portfolio performance, that we have been able to do far better. Our focus is more on mining and manufacturing. Okay, let me quickly move what we do. This is very important क्योंकि हम काफी बार macro की बात करते रहते हैं, जबकि it is companies that create wealth. We are very firm believer that at the end of the day, through the last 20, 21 years, 30, I have been in the market. I have seen ups and downs only in the markets, but there are various companies which have seen significant wealth creation. So at the end of the day, while we can keep on discussing about Russia, Ukraine and all that, there are companies which are doing very well, the companies which are investing into the future, and they have been very clearly have some strength that they keep on doing well in the good times and they survive in the bad times. I think that is where our team day in, day out looks for companies which can do well in good times and survive and thrive in the bad times also. So our framework is BMV, identifies solid good businesses. Every business which can grow faster than GDP, have certain right to win some sustainable competitive advantage, and generally invest into the industries which are consolidating versus industries which are stagnating. I think these are the three things out of another 100 things which are we look when we evaluate each business. Once we like the business is when we go to management. If we don't like the business, management doesn't matter, valuation doesn't matter. So every company that we buy, we need to like the business. Then we come to management, where we're looking at competence, we're looking at corporate governance. अगर दोनों से ऐसे एक में भी प्रॉब्लम होता है, then we actually don't go even up to valuation. We have to like business, we have to like management, and then is when we go to the valuation, where we obviously are ready to pay some price for good business and management, but we are not of the school which says quality at any price. So we like to buy quality, but we like to buy quality at a reasonable price, not cheap, but not very expensive. Fortunately, today is the environment where our reading of the market is such where the businesses which you are finding quality didn't have great past, and to that extent, they're reasonably priced today. So today, that's not a problem for us. We're able to find good business, good management at a very, very reasonable price. Our team, we have an army of 21 analysts which tracks 440 companies for us. So there are 440 buys for us. Within that, the PMS team further evaluates 440 companies and identifies 110 odd companies which are solid, good growth companies going through a BMV filter, which I spoke about in the previous slide. Then we, depending on the strategy, whether it's Contra, whether it's Pipe, whether it's Flexi, we identify 40-45 companies which fit into that. And then obviously, depending on the valuations and the current expectation from the individual companies, we decide on the 25-30 stocks. That's the portfolio we build. As I said, we have a strong team of fund managers Apart from myself, Kritika, Suraj, we also have Sandeep, we also have Sanket, who are part of the team, Dhaval and Preeti, part of the dealing team. So we have already a 7-member strong team on the PMS side. Uh, as I said, we also have another 21-member strong team as far as research is concerned. So these are the companies these are the people who provide research to our mutual fund team as well as to our PMS team. So this research is available to us, which is working also for the mutual fund team. Quickly, I'll just stop here and spend 5 minutes, and then maybe we can go to the portfolios. But this is basically synopsis of everything that we discussed so far. That what do we like going forward? When we do lot of bottom-up analysis, when we find companies which are doing very well on earnings front, the companies which have improving return on equity, I think these are very important two aspects in the stock price. What we are finding today is actually we are finding too many companies which are doing extremely well and are reasonably priced in the mining, manufacturing, and banking. Whereas these are also there are select few good companies here also, but more and more companies that we evaluate from the IT side, from the B2C company side, we might not be liking earnings or we might not be liking valuations. Some of them where we like both earnings growth and valuations, we tend to own them. But we are more overweight on the top. That is what I wanted to say, that our portfolios are more overweight in manufacturing, mining, and banking, given that we have the fastest earnings growth rate there and improving ROE is there. Whereas we've been underweight a little bit on the B2C companies, households, which is stressed today, given that the petrol price is going up, diesel price is going up, food price is going up. Well, government is trying to help these households, but it is unfortunately not going to be enough, and that we will see some slowdown here. My last slide, a couple of slides on the portfolio and performance. I think again I'm repeating, here is where we very clearly are overweight. If you see earnings growth companies, even before 2-year CAGR is also significantly high, which is pre-COVID to now. And even in last 1 year, obviously in the COVID year, the earnings growth rate has been very, very strong. This ROE, which was low number from the Indian standards, it's actually a very good ROE, but even then, this ROE is now from March 2021, given that the earnings growth rate is in excess of 100%, I think we should see ROEs also inching up towards 16-18% for this portfolio. There are two things which are important, growth and ROE. And obviously, never to forget, there is also a PE multiple. So if you see our contra and the pipe portfolio, we have very, very solid earnings growth rate. We have improving return on equity, and we have very reasonable valuations. Even FlexiCap strategy, which is a little more diversified than the contra and pipe and has a little bit of more consumers than contra and pipe, the PE multiple might look high, but it is still much lower than the market. So all the three portfolios have reasonably priced stocks with a very, very solid earnings growth rate. This is a little bit of snapshot of the portfolio that we have. As you can see, each company that we invest in have a strong moat, have a leadership position. Banks at 28.67, we have one of the topmost banks of the country which are part of this portfolio. The second being ferrous metals, where we have again the leading steel producer, leading iron ore pellet producer in the country. Very, very profitable companies now. They had a difficult past, but now they're looking extremely good. Then obviously L&T is another leader in the construction and very strong there. Again, within textiles, we have a leader. So each company that we have bought have certain leadership positions in their own segment, with 68% of large cap and 32% in mid and small cap. There is a portfolio which is very strong on earnings growth rate, as I showed you before, and also reasonably priced at 10.6 times on the trailing basis. Similarly, pipe has 63% small cap and 37% mid cap. Here we intend to buy into companies and hold on to them for 3 to 5 years, from where they become small cap to mid cap and mid cap to large. So very clearly, again, a portfolio of companies which have leadership in their areas, and also a very strong earnings growth rate with the reasonably priced stocks, as you can see. This has a little bit more of manufacturing and less of finance, whereas Contra has a strong financial portfolio also. Given that we actually like only leaders and large banks, we really are not very, very enthusiastic about owning the small banks. So that's why Pipe is much lesser bank than what you find in Contra. Flexi, again, as I said, is got a little bit more diversified portfolio. Strong on banking, strong on industrial products, telecom. It has a little bit less of metals compared to Contra, and rightly so, with 83% in large cap, 14% of mid cap, and only 3% small cap. So this is relatively far less volatile and far more stable portfolio than what you find otherwise in Contra. So all three portfolios are doing very well for us. If you see over a 2-year period, Contra has 8.5% CAGR outperformance over the market. Over a 3-year, it has got 5.4% outperformance. Pipe again has a very, very strong outperformance in near term, and since last 2 years also, since inception also. And similarly, FlexiCap is also consistent performer and doing better than the benchmark through all the periods. So this is where I want to stop. I want to reiterate and summarize what I said. Very clearly, the environment has changed. There has been a significant underinvestment in mining and manufacturing, not only in India, but globally. We believe India, with 1.3 billion people, have been consuming oil and gas, have been consuming mobiles, have been consuming electronics and refrigerators and air conditions without producing them, without manufacturing them. I think the time has come when India will have to manufacture something for the rest of the world. We can't just keep on shipping IT services because we are not able to pay enough, to be very honest. We are not able to cover our imports cost with our exports. To that extent, our remittances help a bit, but nevertheless, we need to manufacture a lot more. Make in India, PLI, you can talk about increasing the taxes for the new investment. Government have been aware of that challenge. They're also investing on infrastructure to improve productivity. So whichever way I look at it, we are very, very confident that the select companies that we have chosen, again, I'm not talking about themes and all that, the select companies that we have chosen for our portfolio are reasonably poised to deliver strong earnings growth in times to come as manufacturing picks up. At the same time, they will also, be conscious of the capital allocation. To that extent, ROEs will also remain benign. I'm not saying ROE will keep on going up towards 50-60%, but ROE will be far better than the cost of capital. The combination of earnings growth rate and improving ROE, I think, makes it a solid portfolio of companies which are reasonably priced. So with that, Daniel, I think I can stop here. I tried to cover as much, though it was in a jiffy. So if you think some of the things I've covered, but still there are questions around it, happy to take that. But I thought I leave more time for question and answers, not spend enormous amount of time on the presentation only.
Yeah. So thanks, Anand, for your quick and crisp presentation about future is not equal to past. So here we have a few questions, from our participants. So let me read out, one by one. Probably you can be able to, share your thoughts on that. So the first question is like, Russia-Ukraine has created a lot of headwinds in global commodity prices, and the war is not seeing the end still. And if war prolongs, how equity outlook changes? The first question.
Yeah, so just to add to what I already said, that it means higher inflation. It means the central banks will tighten a little bit more, even for next 6 months, but they will tighten more than what otherwise they would have tightened, which means that central banks want lower demand, lower growth to counter for the supply disruption that has happened. So it is not a structural. We believe both Russia and Ukraine would be happy to start supplying these goods and services that they have not been, goods particularly, they have not been able to ship. So as and when this ends, but in the meanwhile, very clearly we are seeing more tightening on the monetary side, which means lower growth. So I think from the equity outlook, some of the sectors, some of the people actually benefit from this. If you're a metal producer, if you're an oil and gas producer, if you're a farmer of wheat, you all have benefited from a higher. Who pays the most is the consumer and the B2C companies. So I think from the equity outlook point of view, if you are expecting a lot of growth from a certain company, you will be disappointed. If you're paying too much for growth, you'll be disappointed. And that is what you want to be cognizant about.
So, and the raising inflation to an extent good for equity returns. And do you think inflation is transient, and how it will affect the growth of Indian economy?
I mean, good point you made. Whomsoever asked that question, thanks for asking. Yes, a benign inflation is actually good for equity markets. Deflation is something which is the enemy of inflation, of the equity markets. But a very, very high inflation is also not good. And to that extent, I think central bankers are trying to tame to not make this a very high inflationary environment. So as long as the central banks are successful in bringing down the growth little bit and keep the inflation under control, I think equity markets need not worry. To that extent, we will have some more pricing power. Our ability to pass on the fixed cost increases in the form of higher electricity charges, higher people cost, is well absorbed if you have a benign inflation. Then.
Okay. See, RBI governor has announced the unscheduled rate hike of 40 bips. And yesterday in an interview told inflation control is number one priority. And does this affect our equity outlook in medium term? So what's another question?
I think everybody is worried about market, and rightly so. But I'm again repeating, a lot of these risks which we are seeing in the form of higher commodity prices, in the form of higher rate hikes from the RBI and the US Federal Reserve, I think these are all expected lines. And to that extent, markets, generally are not that, significantly react negatively to the known risks in the market. So if you ask me personally, if I were to just continue and talk about the way I've said that these are the risks which, market is well aware of, the government is aware of, the central bank is aware of, the fund manager is aware of, and now to the extent the investor is also aware of. So to that extent, a lot of risk management is already happening. RBI is raising interest rate to make sure that we don't have an hyperinflationary environment. We have an environment where the demand slows down a little bit, and to that extent, the inflation is not very high. I think not only RBI, but the US Fed is also trying to achieve that. Even UK is trying to achieve that. Some of the inflation might take is transitory, especially ones which are related to the supply disruption from Russia and Ukraine are more transitory, I would want to believe. Nevertheless, even if they're not transitory, the demand and supply will adjust. And to that extent, at some point of time, the prices will rise to a level and that will stop rising. Governments are trying their bit to reduce inflation by, putting up some export duties on sugar and steel and others, which are again temporary measures, but they're required today in the current environment for inflation not to become too high. So these are the things, we are just seeing, which is why there is muddle. If investor is looking to invest in the equity markets, the right approach should be more STP, because we don't have an answers to everything. We don't know when the war is going to end, when these supply disruptions that are coming from Russia and Ukraine will ease. And given that we don't know that, Anything between 3 months, 6 months, 12-month STP is something which is advisable for the investors, given market is already corrected also. To that extent, some bit of these risks are priced into the markets.
Okay. See, the next question is how the share price reflects the ROE along with profit growth, and which is more important?
I think in the short term, it is EPS growth is very, very important, but in the long run, the sustainable ROEs are very important. Does your business have a sustainable competitive advantage which allows you to make high ROEs for many years to come? I think these are the important questions to be answered. And to that extent, ROEs also matter, EPS also matter, the delta EPS also matter. The profit growth means that you have more cash flows. Now, how you deploy this cash flow into the future capex is very, very important, which will drive where your ROEs are. And that is where our team comes in. That is where our evaluation of all these future plans of the business comes in. So companies do guide on where they're going to invest into the future, what part of the business they're going to invest. We do evaluate saying this capex will improve the ROE or whether it will reduce the ROE. And by that logic, then we evaluate whether the sustainable ROE for this business is there. And that will then determine the PE multiple. So as I tried to explain in a very, very simplistic fashion, because this is the ABC class of investment, that at the end of the day, price is nothing but EPS into PE multiple. So while when we talk about profit growth rate, we are talking of delta EPS. What happens to the PE multiple of the company? What is the starting point? What can be the end point of the PE multiple is decided by where is the ROE stabilizing for those businesses. So yeah, it is equally important. It's not one versus another, though in the short term, it's always the EPS which drives the stock price. But in the long run, the PE multiple will be driven by the ROEs, stable ROEs of the businesses. And that's why if you see in our portfolios, we are very, very careful. Our continuous interactions of with the management or our evaluation of the business cycles and all that, we are very, very conscious that these ROEs, which are low in March 21, and because of which their PE multiples are low, are they inching towards a high number of 18 to 20%? And once we are convinced that that's happening is when we actually include that stock into our portfolio.
Okay. So the next question is like profit to GDP ratio was at 7.8% in 2008 and came down to 3.02 in 2018. And how is this key metrics will pan out in next 5 years, taking into account inflation and rising interest rates?
Yeah, so as I said, this is what was happening. You see a lot of deflationary pressures were there from China. China was able to produce anything and everything at a very low cost, given that the scale they had built. And that was creating a lot of havoc in the manufacturing industry outside China. There's very little pricing power, there were a lot of losses, and that brought down the profit to GDP for all the businesses. I think that is changing. China is now more focusing on pollution, their manpower availability is reducing, their manpower cost is going up significantly. And they're also focusing more on value-added manufacturing. So what we are seeing is immediate relief that we have been seeing for the last few years on the low end, the first level of manufacturing, which is commodity manufacturing. If I see the prices of commodity chemicals like caustic soda, soda ash more recently, or more recently, if you see the commodity prices of steel and aluminum, where government to intervene last week, all were doing extremely well, and that's because China is reducing its capacities there. And that's why if you see profit to GDP is already after touching a low in 2020, has inched up towards 3.5%, 4% in this year and will continue to inch up. That is what our take is. Because now not only B2C companies, but the non-B2C companies will also do well in terms of profitability. And that reflects in a very strong growth rate which we have seen in our portfolios last year, because we had so much more manufacturing. So our portfolio is actually outperformed the overall non-B2C also. So within the non-B2C also, we have been able to capture the faster growing non-B2C businesses. Even within B2C, we have been able to identify which are the faster growing B2C businesses.
Okay. So does the structural reforms like GST, RERA, corporate tax cut, and PLI will fasten Indian economic journey towards 5 trillion, which is much faster than earlier estimates? What your view on this?
I think in India, the services always did well. It was the manufacturing and the farming which has kept us back very clearly. So now with farming, obviously the inflation, the food inflation would help to increase. Not the volumes cannot grow up significantly. But I think for India to go towards $5 trillion economy, now we will have to export more and import less. I think import substitution and export growth rate in manufacturing both are very, very critical to take towards 5 trillion. And that's where the PLI, China Plus One, GST, which improves the overall compliance of taxes, improves the competitiveness, the formalization of economy. So yes, in bits and pieces, every reform that government does, every big infrastructure project. So they have also put up an infrastructure project called DFC, Dedicated Freight Corridor. So all along in India, the goods traveled on the passenger railway lines and always got the secondary treatment. So invariably, a particular container which has to move from say Ludhiana to Mundra port or a GNPT port used to take 2 days at times. Now, with the help of dedicated freight corridor, these timelines can reduce to 1 day. And that's how now a lot of containers which have been moving on roads can now move on the railways because the time is cut down to half. So those are the various benefits, and that reduces the logistics cost, that reduces the overall cost for the manufacturer. And these are very important steps which are required to boost the manufacturing. So I agree with you, some of these reforms, some of these infrastructure creation, all will help to India to hasten becoming a manufacturing hub or an alternative to China. I'm not saying we will be able to be as big as China, but even if you become a decent alternative number to China, I think it will help us to hasten to $5 trillion very fast.
Okay. So next question is about your research. Like in a crowded PMS space, how the ICICI research helps in creating a portfolio with a manufacturing and mining sector, which shows a great promise now.
No, so we are not a PFS fund manager which only invests into manufacturing mining. It is now. I think this is very important. Are we ahead of others? So while the world is still investing in B2C businesses, still investing in the erstwhile quality businesses, people are missing that those quality businesses ROE will be going down, and these businesses ROEs are going up. These are the future quality businesses. So it is not about buying what has done very well for last 10, 15 years. It is also buying stocks which can do very well in the next 5 to 10 years. I think that is very important. And that is where our research comes into our team of analysts. While so a lot of people would only have 3 to 4 analysts, and they will not be able to waste time on tracking many of these manufacturing sectors which are not doing well. Whereas for us, whether these sectors are doing well or badly in the short term, we still track those sectors. So while we track consumer-facing businesses also, but we also track the non-B2C businesses all along. It's not today. It was last 10 years. We have been constantly tracking it. So this large research teams allows us to be ahead when the sector's fundamentals are changing, the earnings is changing, the ROEs is changing. I think we will be able to capture it ahead of others, given we have a large team which is continuously evaluating these businesses.
Okay. So the strategy did exceedingly well with a CAGR of 20.5% over 3 years of contra strategy. Do you believe it can be replicated in the future? And how do you define and measure a resilient portfolio with the given macro headwinds?
I think returns are an outcome. Returns are not something we target. Returns are not something which you can predict. But I think this is what is very important. I think that's why more than returns, this is a slide which I believe is very important. What is the science behind returns? As I explained to you, delta EPS and delta P multiple drives the stock price performance, right? So we have delta EPS in our control. Corporates have the delta ROE in their control. So we've been evaluating businesses which are improving return on equity. And this return on equity is already improved by 200, 300 basis points in last 12 months. So yes, resilience comes from buying solid growth businesses at a reasonable price. If you're buying a good growth business at 80p, you might not make money for a few years. You might lose money in next 2 years. It's very much possible. We have seen in history, in the environment of 2001 to 2009, which was very similar period when inflation was high, a lot of these B2C companies are down by 50%. So to say that I will buy good businesses, the so-called businesses which have done very well in last 10 years, I'll just buy them at any price, doesn't work. The resilience comes from when you have bought solid growth businesses, improving return on equity at a reasonable price. Luckily, fortunately, especially if you see contra and pipe, today, because we are more overweight on mining and underweight on B2C, people are just not aware, or people are just not even conscious of how things are improving from manufacturing. We are able to buy them at a reasonable price of 10p multiples, trailing basis, forget forward, trailing basis. So I think the resilience comes from identifying good business, good management, and buying them at a reasonable price. And the outcome of 20.5% is an outcome of overall, it has multiple factors. Factors like GDP growth. And within GDP growth rate, there is a real growth rate plus inflation. So if inflation is very high, obviously the real GDP, the nominal GDP growth rate will be very high. So over long periods of time, if you see nominal GDP growth rate is between 11 to 12%, the profitability is improving, at least in the short term. And to that extent, if the profit growth rate at the Nifty level is say 13 to 14%, with our research, with our focus on select companies which are going to grow faster than GDP, we keep on targeting that typically the earnings growth rate of our portfolio companies should be at least 500 to 600 basis points faster than the Nifty earnings growth rate. So we do target companies with 18 to 20% earnings growth rate. And that is where we find that sort of returns which have come through. But again, the future returns are never guaranteed. And 3 years is a short period of time from the equity investment point of view. I want to reiterate, take the opportunity since you asked me this question, is that if you're coming into equity, if you have any horizon less than 10 years, these are the risks. You have 15% risk in the 5 year also. So even a 5 year is not a guarantee of making money. Obviously, positive returns you will get, but you will not cover your cost of capital. Say 6% is your cost of capital. So I think as you invest your long-term savings in equity, please bear in mind the long term is not 1 year, long term is not 3 year, long term is minimum 5 year, all the way up to 10 years. If you can invest for 15 and 20 years, nothing like it. That's the greatest thing that can happen. So, yeah, that is my answer to your question. That we will build solid, strong businesses, reasonably priced. That's the way brings the resilience to the. And obviously, each company that we invest needs to have a right to win, needs to have a sustainable competitive advantage. I think when we said that our model is we spend enormous amount of time evaluating only businesses. We spend so much time in this evaluating business, and before buying that, we already looking at what are the economic moats, what are the strengths that this business have. For every company that we buy, we would have rejected few companies. So resilience comes from evaluating before the event. whether this company can survive the downturns, can company survive Russia-Ukraine crisis. If you see our pipe portfolio, uh, it built of the companies which produces certain commodities could survive this Russia-Ukraine crisis here, if you can see. So we keep on looking for businesses which can survive these difficult times and thrive in the good times. So very clearly, resilience is an outcome of our enormous research in identifying strong businesses, having right to win, having sustainable competitive advantage, and buying at that reasonable price, waiting it out. At times, a good business is not available at cheap price. We don't jump into it. We wait it out at either there's a time correction or price correction. We are finding so many good companies today at such a reasonable price that we actually don't have to wait it out. Today, we are already deploying it fully.
Okay. And we see US talking a little on recession. Maybe they fall more in next 2 to 3 months. India is better placed. Will we follow them or carve our own path? When do you see FIs coming in again into Indian markets?
I think, as I said, there is an overreaction because of the Russia-Ukraine war, and because of that, there has been a significant higher inflation. So I think market is overreacted on the other side also. The interest rates in US have risen very high. The expectation of rate hikes have gone up much higher. My take is over next 3 to 6 months, as things stabilizes, people will realize that the economy is already slowing down very fast. Inflation expectations will come down, and to that extent, once the US Federal Reserve pulls back a little bit from a tightening curve, I think FIs will again start flowing back into the country. But again, I'll not depend on that. I don't worry about US in deflation or a US recession. Our companies that we have picked have been stress tested for many of those things. If you have a 3 to 5 year horizon, even if you're afraid in the short term, if you want to commit money, do it in 3 to 6 months STP, so that these small fears are taken care. Look, don't come for the short term. Don't take a market view and enter. You have to come with a mindset that I want to spend time in the market. So once you've decided that you want to spend 5 years, 10 years, 15 years into the markets, the investments that you have made is meant for that tenure, then it doesn't matter whether you invest in 3 months' time or 6 months' time or 12 months' time. I mean, that's up to you. But to me personally, I think the environment in which we are, you're better off doing an STP rather than a lump sum as we speak.
Okay. So due to time constraint, I am now clubbing some 3 questions into single questions. Maybe questions will be a little large. So how much a PMS can generate alpha over a mutual fund of similar mandate in terms of 5 years CAGR? And then is it the right time to enter into PMS? Out of your 3 portfolios, which is expected to deliver higher return?
Yeah, so I think very importantly, if you see, the PMS is boutique portfolios. They are not mutual fund portfolios. If you're getting a mutual fund portfolio in a PMS, then that's not the right thing. PMS is meant to deliver to you an experience which is far better than the mutual fund. In the process, you have to also appreciate, and you should see the downside also, that we build a far more concentrated portfolio of companies with very high conviction. If you see, in a contra portfolio, we have 15.28% in ferrous metals. That's our conviction. In a mutual fund world, rarely a some portfolio would have that sort of high exposure to the metals. Similarly, we have 12.56% exposure to the transportation sector. Now, again, this is very rare, but you're getting it. So, my point to you is that the PMS gives you boutique portfolio which is meant to generate higher return than mutual fund and have to have a differentiated portfolio. If you're getting that, then obviously over a long period of time, PMS you'll see, and this performance is there to see, that even in the environment where mutual fund has not been able to outperform the benchmark over a 3 year period, we have been able to generate significant alpha for our investors in that same period of time.
So we have received many more questions. So due to time constraint, like we couldn't able to address all these things. So Anand, what we will do, we will collate all the questions and send it across to you. So probably we will get answers from you and send back to our participants. Dear participants, if you have any questions to Anand Shah regarding the product and other stuff, so probably you can email your questions to events@pmsbazaar.com. With that note, once again, I am thanking you for all the participants, and thanks Anand for this insightful session. Wishing you happy and safe weekend. Thank you, everyone. Bye.
Thank you, Daniel. Thank you, PMS Bazaar, and thank you to all the participants who have joined for this call.